inflation that they're headed towards. And so even the world economy is important to us. If you think about it a second right now, it's amazing that we're still struggling with a global recession for most of the developed world anyway, and yet we've got oil prices at $82 a barrel. That's an amazing phenomenon. We had the Asian crisis of 1997, which was a blip compared to what we are experiencing today. And yet it was the aftermath of the 1997 Asian crisis that we saw the price of oil go below $10 a barrel for a few weeks in June of 1989. So you need to understand that the national story is important to us, and the global story is important to the national story. I want to start off by kind of reviewing some material that I covered in the fourth quarter ahead of the curve that I did for PRS, and look a little bit from a historical perspective, because in part I think that we were hoodwinked a little bit with irrational expectations about what it was going to take for us to get out of this recession. The recovery seems painfully slow. The Fed is worried about the still possibilities of deflation. If you take a look at it, we've not had the type of economic recovery that you would normally expect in a post-recession period. Oftentimes, during economic recovery, you'll see growth rates of close to 8% as we kind of pop out of the recession. This decline that we had during the recession, that is the worst decline we've seen since the Depression. And so you would have expected, or at least hoped, we'd have seen a substantial rebound. Fourth quarter of last year was impressive, except it wasn't quite so impressive when you look at the bottom line. The fact of it is that over half of this growth in GDP during the fourth quarter of 2009 was associated with the inventory adjustment. During the scary times of 2008 and 2009, businesses just absolutely let their inventories go to zero. And so there was this natural rebound in inventories. If you look at the consumer spending, surprising to many people, actually, in the fourth quarter of 2009, government spending fell. The only other positive news in that fourth quarter was that we began to see an important spillover effect associated with a weak dollar, and U.S. exports started to grow. Here's the employment story. The employment story looks equally bleak, but when you had that type of a decline in GDP, you were going to have a major decline in employment. We haven't seen anything kind of like this. Actually, this number should have been updated. We lost, at its worst, we lost a little over 8 million jobs in the U.S. economy, about 8.2 million jobs. And so this is pretty meager job growth that we're seeing associated with quote-unquote recovery. This takes a look at employment growth, but it looks at it from a little bit more extended period. It goes all the way back to the double-dip recession of the early 80s. And you can see, even with the double-dip recession, if you want to look at total job losses, just think of the area under these curves. And look at the area here versus the area here. So even the double-dip recession of the early 80s was not nearly as severe as what we've experienced here. And this, if we continue to see job growth at this rate, it is going to take a very long time for us to recover back to our old levels of employment. Initial claims for unemployment, we started off the year with some pretty good news. Actually, it began in late 2009, but this level of initial claims for unemployment, while substantially lower than our peak, is still substantially higher than you would expect for a true economic recovery. In fact, if you take a look at where we are right now, where we are right now in terms of initial claims for unemployment is as bad as the worst of it was in the early part of this century, the tech bubble recession, and this was the S&L crisis recession. So, you know, where we are now is as bad as the peaks were in the last two recessions. So we got a long ways to go. If you take a look at consumer confidence, again, we've had a rebound in consumer confidence, but where we're at right now is again equivalent to where we were during the S&L crisis, and is only slightly better than where we were during the double dip recession of the 80s. One of the things, because of the consumer confidence is low, what we've seen is we did see a fairly nice rebound in retail sales about 12 months ago. That's calmed down significantly, and retail sales now are growing. And the positive thing is that they are growing. We're seeing retail sales grow at about 2% annualized rate, which is relatively good news, but it's not strong enough to really give us the momentum that we need. But the whole story really is about job growth. You know, and if we talk about the last recession that we had, everybody called it the jobless recovery in 2003 and 2004. I mean, the economy, when GDP was growing, but we just weren't getting any employment. That's the problem we've got today. If there was one of the motivating facts, forces associated with our election a few weeks ago, it was jobs. Everything was about jobs, and that remains to be the theme, and it's going to be the theme for 2011. Is jobs, jobs, jobs. The Fed is committed, and they are under a lot of political heat right now over the QE2 stimulus to try to buy bonds at the long end and try to stimulate the economy further. But what they're saying is that enough's enough. We got to get jobs growing again, and we got to get this unemployment rate, which seems to be stuck at around 9.5% down. This is a hard graph to see. I apologize for it, but if you will put on your color eyes, okay, and only look at one color at a time, you'll get a sense of, to some extent, of our impatience. And our impatience is associated with the fact that it's always taken a reasonable amount of time to get the economy really going back, growing again. Red, that's the major recession we had in the mid-70s. If you take a look at red, and what I've done here is I've defined recession and the length of a recession in terms of how long did it take to get back to our old level of GDP, just to get back to where we were at the old peak. And if you take a look at red, here's the double dip. We had this little nice surprise, and then it came back down again. The trough of the 1970s occurred in the 8th month. So we didn't bottom out for 8 months during that recession. And if you take a look, here we are in the 11th month. It was the 11th month of the recession. So that's almost 3 years before we got GDP just back to where it was before the recession had begun. Similarly, if you now put your blinders on again, you focus just on the green, that's the double dip recession. Down we go, up we went, down we go again. It wasn't until the 13th quarter that we were able to get GDP back to its old high. So to some extent, this notion that I think Americans believed that there was a magic bullet that was going to get us out. You saw how severe the recession was. And now we anticipated that we were gonna get out overnight, but that's just was totally irrealistic.